Right now, as we watch the live ticker tape on this volatile Wednesday afternoon, Rivian Automotive Inc., ticker symbol RIVN, is trading at 16.14 USD, posting a significant intraday gain of plus 0.58 or 3.71% as of this very moment. The market is moving with conviction, and the volume we are seeing today is not just retail noise, it is the sound of institutional capitulation. We're witnessing a stock that has been battered, bruised, and left for dead by the skeptics, finally proving its structural thesis. The price action at $16.14 is attacking critical resistance levels that have held this stock down for the better part of a year. If you are watching your Robinhood app or tracking the order flow on Webull, you are seeing a distinct shift in character. The selling pressure that used to emerge at every rally is evaporating, replaced by a steady bid from capital that realizes the bankruptcy risk is now effectively off the table. The expectation for Rivian has long been that it is simply another casualty of the EV winter. The average investor, perhaps scrolling through a SoFi Invest feed or reading headlines about cooling electric vehicle demand, likely categorizes Rivian alongside Fisker or Lordstown Motors, companies that had great designs but ran out of cash. The expectation is that they are burning money on every truck they sell and that competition from Tesla stock and the Chinese automakers will eventually suffocate them. That is the expectation, a niche luxury truck maker with a broken balance sheet. But the reality, and this is what is driving the stock up nearly 4% today, is that Rivian has successfully crossed the valley of death by achieving positive gross profit. The reality is that the recent Q3 financial results, which showed a consolidated gross profit of $24 million, have fundamentally broken the bear thesis. They are no longer selling dollar bills for 80 cents. They are making money on the core mechanics of building vehicles. And when you combine that with the massive capital injection from the Volkswagen joint venture, you have a company that is not just surviving, but preparing to dominate the mass market with the upcoming R2 platform. To understand the magnitude of this move to $16.14, we have to look at the Volkswagen moat. Most people think the $5.8 billion deal with VW was just a lifeline. It was not. It was a validation of Rivian's intellectual property. Volkswagen, one of the largest automakers in the world, did not invest billions because they needed help bending sheet metal. They invested because they needed Rivian's electrical architecture, the zonal architecture, that significantly reduces wiring, weight, and complexity. This technology is the brain of the car. When a giant like VW admits they need Rivian's tech to power their future Scout and Porsche models, it tells the market that Rivian is a technology licensor, not just a car manufacturer. This shifts the valuation multiple. Tesla stock commands a high multiple because it is viewed as a tech company. Rivian is now earning that same right. For a Schwab Intelligent Portfolios algorithm that scans for quality growth, this shift from hardware-dependent revenue to software-enabled partnerships is a massive green flag. Let's talk about the institutional flow because that is what sustains a rally. We are seeing a rotation. The hedge funds that were shorting this stock into oblivion are now scrambling to cover. But more importantly, the long-only funds, the massive pools of capital managed by Fidelity Wealth Management and Vanguard, are starting to build positions. Why? Because the bankruptcy risk was the only thing keeping them away. Now that the cash runway extends well into the launch of the R2 in 2026, the risk profile has changed. They are no longer betting on survival, they are betting on execution. The volume today, pushing past average daily levels, suggests that these large institutions are stepping in to defend the $16 level. When you see BlackRock or State Street increasing their holdings in the 13F filings, as we have seen recently, it creates a floor under the stock price that retail traders can lean against. However, we need to address the R2 narrative because it is the engine of this future growth. The R1T and R1S are incredible vehicles, but they are expensive. They are $80,000 plus purchases. The R2, which is slated for production in the first half of 2026, is the game changer. Priced about $45,000, it targets the meat of the market, the exact segment dominated by the Tesla Model Y. The market is looking at $16.14 and asking, can Rivian replicate the Model 3 moment? The answer seems to be yes. The production lines in Normal, Illinois are already being prepped. We have seen the prototypes. The design is locked. By moving production to the existing Illinois plant instead of waiting for the new Georgia facility, management made a brilliant tactical retreat that saved over $2 billion in capital. This decision, often criticized at the time, is the reason they have the cash to get to the finish line today. Let's pause on the business model because it is often misunderstood. Rivian is not just selling cars to consumers. They have a massive commercial backbone with the Amazon Electric Delivery Van, EDV. If you order a package from Amazon, it is increasingly likely it arrives in a Rivian. This commercial business provides a steady, predictable baseline of revenue that other EV startups lack. It acts as a hedge against consumer cyclicality. If the consumer economy slows down, Amazon still needs to deliver packages. This dual revenue stream, consumer luxury plus commercial logistics, is a unique structure that appeals to risk-averse investors using Fidelity brokerage accounts. It provides a level of stability that allows the company to take risks on the consumer side. I want you to take a second and check your own sentiment. Comment below how many shares of Rivian you currently hold or if you have a reservation for the R2. It is fascinating to see if the retail investors are holding the stock for the R2 launch or if they are trading the volatility of the R1 production numbers. Analyzing the intraday action, the stock is currently battling the 200-day moving average. This is a key technical line in the sand. If Rivian can close above this level, it signals a long-term trend reversal. Traders using interactive brokers trading platforms are watching the volume-weighted average price, VWAP, closely. The stock has stayed above the VWAP all day, which indicates that buyers are in control. They are stepping in at every dip. The Relative Strength Index, RSI, is rising, but not yet overbought, suggesting there is still plenty of fuel in the tank for this move to extend toward the $18 or $20 range in the coming weeks. Let's discuss the gross margin victory again, because it cannot be overstated. For years, critics pointed to the fact that Rivian lost $30,000 on every truck. That number has collapsed through the Peregrine project, a massive re-engineering effort to simplify the vehicle and reduce costs. They have turned that loss into a profit. The Gen 2 R1 vehicles are cheaper to build and easier to assemble. They removed hundreds of parts. They switched to LFP battery packs for the standard range. This is the unsexy work of manufacturing engineering, but it is what saves companies. If you are looking to invest online in a manufacturing turnaround, this is the textbook definition of it. You fix the unit economics first, then you scale the volume. Rivian has fixed the economics. Now they are ready to scale. We also have to talk about the software-defined vehicle aspect. The joint venture with Volkswagen is explicitly focused on this. Rivian's software stack is years ahead of the legacy automakers. The infotainment is snappy. The over-the-air updates actually add features, and the app integration is seamless. This is what the modern car buyer cares about. They don't care about horsepower as much as they care about whether their Spotify connects instantly. By monetizing this software through the joint venture, Rivian is creating a high-margin revenue stream that looks more like a tech company than a car company. This is why you see comparisons to Apple stock in terms of ecosystem lock-in. Once you get used to the Rivian software interface, it is hard to go back to the clunky systems of a traditional Ford or GM vehicle. There is a risk, and we must be balanced. The EV market is cooling. Interest rates, while stabilizing, are still relatively high compared to the zero-rate era. High rates hurt auto loans. If the Federal Reserve keeps rates higher for longer, it puts a ceiling on how many $80,000 trucks Rivian can sell. The demand cliff is the biggest fear. Furthermore, the competition is fierce. Tesla is aggressive with price cuts. The Chinese manufacturers like BYD are knocking on the door. If Rivian cannot get the R2 out the door on time in 2026, the market will punish them severely. Delays are deadly in this industry. Investors using Fidelity IRAs for long-term growth need to be aware that this is still a high beta stock. It will swing wildly based on monthly production numbers and macro headlines. However, the brand is a massive asset. Rivian has cultivated an image of adventure and capability that resonates deeply with American consumers. It is the Patagonia of cars. This brand equity allows them to maintain pricing power even when competitors are discounting. You don't see Rivian slashing prices every month like Tesla does. They are protecting the brand value, which protects the residual value of the vehicles for existing owners. This long-term thinking builds trust. Trust is the currency of the premium market. Let's look at the service network. One of the biggest complaints early on was the lack of service centers. Rivian has been aggressively